Hey guys, as I promised, back for Tuesday round here, a little bit of Tuesday intelligence, bringing back on Dave Bennett from our secondary marketing side. It is the 25th of August, and reason for the background here, I've got Dave. He's gonna be flowing some knowledge on all of this. We're gonna get into the alchemy of interest rates, going into the background and the depth of what really happens when the lock happens. Recap a little bit what we talked about last week with the markets, and if you noticed, didn't do the break today. I'm going full on wizard beard because if you got a wizard on here, you got to look like one as well. So I'm just trying to keep up with my company. So thanks for coming back, Dave. Appreciate you, brother.
My pleasure. Good to be with you.
So let's do a little screen share here as we get into the discussion of the interest rates. Let's just talk about where we are today. Notice that as far as the market closed out yesterday, it closed a little to the downside. In fact, it opened to the downside, tried to get up back where it was the day before, but didn't quite make it, didn't have the legs. Closed at 105.25. Then today opened up and we're at 105.22 as presently as our high. So in your mind, what would that translate to? We got, we only have a 3 basis point difference, but based upon when things may have been priced yesterday for the close of the day to right now, is there really much difference in what we're pricing out?
Yeah, depending on the scenario you're running, it could be an eighth worse in pricing, or it may be exactly the same. A lot of our investors repriced yesterday, kind of to the low end of that bar graph that you're looking at, and so really today's pricing is opening up pretty close to where it ended.
So may have repriced down at the low, is what you're saying.
Correct.
Okay,
Yep.
so low of 105.16, and then coming into today. So, because I did notice a lot of the places where I tend to lock the deals, they tend to take down towards the end of the day. So pricing goes away like right around 1:30, 2 o'clock. Market's closed, and then it comes back up live again 2:30. Sometimes 3 o'clock. I don't know. It's just interesting when it translates over to what I get to see. So when I'm locking towards the end of the day, I'm already priced in possibly at that 105.16.
Yep, you're right. And the reason that'll happen, and I think we'll get more into that as we talk about what happens when you lock a loan, but basically once you hit 5 o'clock Eastern time, there's no great way to hedge the production that comes in after that. So locks that come in after hours. So investors need to be a little bit careful after hours. They don't want to take in a lot more locks than they were projecting, or they risk or taking a loss if the market opens up down the next morning.
Okay, so investors meaning those who put their money up on the mortgage-backed securities pools, those who are taking those funds and putting it to work, and they're hedging as well. I mean, they're trying to make a profit off of that move, right? Because they
Absolutely.
promised somebody in this situation, we're looking at the Fannie Mae 3.0. So they promised her to put their money in 3%, right? They're going to get 3% come hell or high water.
Right.
Right.
Yep.
So they're going to get that. So whoever's putting it to work is saying, okay, we're going to hedge tomorrow that we're going to come out better than this. So we need to price ourselves over, for post market trading to be in a position that when the locks come in tonight, that when we have to bundle it all up and start putting all the work into it, that we're not going to be in a negative position, right?
Absolutely. And maybe we could take a pause on that and just go into what happens when a loan is locked. And I think that will help explain what happens after hours.
Definitely. I'm going to stop the share here and bring you up on here so I can have people lean in a bit to your computer, brother, because people need to hear this. They need to understand this. This is the alchemy I'm talking about. This is where it starts to get sexy for those of us who do this kind of thing. And real estate investors will love this too.
So yeah, to start with, so when we accept a lock, when a borrower locks a loan, essentially that lender is buying that loan. We're making a commitment to lend money at that rate. We are buying that loan. And the biggest risk that happens when we have now bought the loan is we've bought it at an agreed upon price. So what happens if the market moves? If the market gets worse, well, too late. We already agreed on a set price. Even though the market's now lower, we still have to honor that commitment. And so at the same time that we buy that loan, in order to hedge the risk of interest rates moving, we are going to sell a mortgage-backed security. And what that will then do is it allows us to minimize our interest rate risk. We've now sold a security for future delivery. And when we when the market moves, if the market gets worse, like we were just talking about, that loan now becomes less valuable. But at the same time, that security that we sold becomes more valuable. And so if we say down the road, market is 100 basis points worse when that loan funds, we still have to honor that earlier commitment, and we've lost 100 basis points on that loan. But over the same time period, we've gained 100 basis points in value of that security. We're now going to buy that security back, and we recognize 100 basis point gain from the hedge. And that's how we protect the value of the loans that we lock. Obviously, that can go in the other direction, where the loan gains value over the time of the lock, and the security that we sold initially would then be losing value. But the great thing about mortgage-backed securities, it's extremely liquid, and it tracks very closely to the loan pricing, and so it works out as a great hedge.
So in a way, it kind of futures trading is what you're doing.
Yeah, a little bit. Yeah, and some people will sell those securities, and then they'll eventually deliver the loans into those securities. But primarily what we do, and what most of our competitors do, is we just use it as a hedge instrument and then just buy it back and realize the gain or the loss on it.
Okay. Very, very interesting. So it more or less, anybody who doesn't have that capability, I don't know who does or doesn't when it comes to this particular part of the world, but if you don't have that capability to play in that hedge world, you're out there on the risk.
The other option that guys that are smaller, that can't play in that hedge world, as you put it, what they would do is they would have to find an investor that will accept best effort locks. And so what that lender would do is they take a lock from Aaron.Chapman. They're going to turn around with, say, Wells Fargo or PennyMac, and they're going to commit that loan to them at today's price, but it's on a best effort basis, meaning I'm going to deliver this loan to you if it funds, but I don't promise you that it's going to fund. And the nice thing about that is it removes the interest rate risk, but the bad thing about it is because it's not a guaranteed commitment, the investor is going to charge you more. And so pricing is going to be a lot worse. In the current market, it's anywhere from 40 to 60 basis points worse to do a best effort lock. So we decide to not do best effort. We accept a little bit more risk, but by doing that, we're able to pass through a better price to our customers.
Yeah, and that's definitely something that I've noticed is the ability to pass a better price, being the fact that we can have more. What do they call that? Since it's not best effort, what is that called?
Mandatory, yeah.
Mandatory lock. Okay, since you have mandatory, it's best to come from you rather than myself. So when you've got that mandatory thing, you're saying, hey, we're going to deliver this.
Yep.
We're going to like this back here. We're going to flow these deals to you regardless. It's just the channel's open, and you're going to accept them. And this is the price we demand for it. And if it doesn't fall, if it falls through and we don't get that deal done, then then we're going to accept the risk of what that I guess that hit or fee or what would that be?
Absolutely. So if we do a mandatory commitment with an investor, we're guaranteeing that we're going to send you the loan or a pool of loans. We typically do it in pools and take a pull through assumption. So typically we'll take, say, $1 million of locks. We're going to assume about 80% of that's going to pull through. So we're going to take out an $800,000 commitment, and we're going to do it mandatory, so we get the better price, which means we guarantee that it's going to come through. So we have to deliver $800,000 in loans to that investor to fulfill that commitment. And if we don't, then there's what's called a pair out fee. Basically, we pay a penalty to the investor because we didn't deliver.
Okay. Yeah, because they had to put some stuff up, and it continues to trickle down the line.
Yeah,
money's guaranteed somewhere, and people have to pay for that. Bottom line, right?
Yeah. So this takes us back to the after hours issue that came up in the beginning. Once the market closes at 5 o'clock Eastern time, you can't buy and sell mortgage-backed securities. So what lenders do at the end of the day is they kind of have to take an educated guess at what is going to happen after hours, and they hedge their position on what they think is going to happen. Now, if right at the end of the day, something happens in the market that makes you think that your assumptions were wrong, then you may adjust the pricing on your loans to try and compensate for that. And that's why there's sometimes you'll see guys shut down their pricing right at the end of business as they try to formulate their strategy going into the end of the day.
Yeah, it seems to be something that I've seen, especially in these last couple months, with all that's been going on, right? And then of course we had the big mess with when, in fact, I'm going to do another share screen here, when we had what was happening with the Fed jumping in at the end of March. Let me see here. I got to go over here to a max, man. It's amazing. It's that far back now that I have to go to the max here. So we saw that the mortgage-backed securities is taking that beating. And as I understood, that was banks having to, or those who had taken a lot of margin calls with the market taking the beating, the stock market having to sell off a lot of assets, mortgage-backed securities being one of them, to be able to pay for those margin calls. And then, of course, the Fed coming in there and dumping capital back in to get us to this point. And now doing what, average of about $4 billion a day is where the Fed is injecting capital still?
Yep. And they're indicating they're going to keep doing that as long as they need to. So we can count on the Fed's presence in this market for a long time.
Well, and the Fed's presence in a lot of markets. I mean, it's not just here. It's, the treasuries, it's corporate bonds. And I don't know to what extent the Fed has their has capital injected into everything. And you go way back. I mean, there was charts I had shown early on in the creation of this particular channel, if you will, for my clients, to show where the Fed had literally no investment or no involvement in mortgage-backed securities at one point. Then all of a sudden they're like, they are the mortgage-backed securities. And I can't say who else is going in there, because it's hard to say when you're talking about $4 billion a day coming from one source.
Right. Yeah.
So the worry here is I don't know what the end play is, and that's pure speculation to even get into the conversation about it.
Yep. Well, they're not worried about the end play right now. They're just focused on what do we need to do today to try and stabilize the market. Which goes back to the earlier last week's topic about the FHFA increasing the cost to refinance for borrowers. It runs counter to what the Fed is doing, which is part of the great frustration in that.
Well, yeah. Well, you've got also, I think there was a couple things going on early on with the FHFA versus what the Fed was doing, and it just seems like there's always going to be some sort of dynamic between those two entities. True. So, as far as after that funds, when we do get a loan funded, get multiple loans funded, what happens from there? What do we have to do? What do we have to be prepared for with those rates? What do we as an organization do with all those funded deals?
Well, at the time we have a funded deal, then we determine who we're going to sell it to. Some companies work a little bit differently, but what we take the loans that fund on a daily basis, and we basically put them out to auction so that we get the best possible price. An investor's appetite changes from day to day, so we try and take advantage of whatever that is on the day that we're ready to deliver it. So whoever wins the auction, we basically commit the loan to them. And at the same time we commit that loan, we're going to then buy out of our previous hedge position, because now we have a commitment where we're going to sell that loan at agreed upon price. And then we deliver all the loan docs to that investor and go through the purchase process. They have to certify the note. They have to go through the way the loan was underwritten to make sure it meets the guidelines. They, depending on the investor, some of them do a more thorough or a less thorough review up front. And some of them do a more thorough review on the back end after the loan's already been purchased. But at that point, the loan gets purchased, we replenish our funds, and then we have more cash to fund new deals.
And so in many cases, as I understand, we do still have the servicing within our walls, or in our sub-servicer. So at least we will still be making with Security National, because we retain the servicing or some sort of white label version of it, correct?
Correct. One of the processes we run through is that auction is that we look at the value of our internal servicing to keep that loan. We're going to sell the loan to Fannie or Freddie, but we also then have multiple choices on what to do with that servicing asset. in today's market, we're finding that our internal values are quite a bit higher than what other guys are willing to pay for servicing. So we're retaining the vast majority of our conventional servicing, which we're almost, the portfolio of loans that we're retaining is almost up to $4 billion now. So that's a growing asset for Security National.
No kidding. As long and keep it a performing asset, it just helps Security National and the valuation of the organization as a whole. So one thing that I did notice early on, we're talking about that whole mess during the COVID crisis or interrupt, and then of course you had the market crash, and then all of a sudden there's a larger increase in the cost of loans because the servicers we were just talking about weren't buying them for a little while there, right? In fact, they came back and said, we're not buying at all. You don't,
yeah.
Wall Street, you don't have the capability to service it. So guess what? We know we got it. We got the infrastructure. You're just going to give it to us. And then you're going to stroke us a little check for that. Is that something that's still going on out there?
Well, I would say that servicing values are still depressed, but not nearly to the level that it was back in March and April. And you're right. The servicing bid was basically negative for probably 3 or 4 weeks, where guys were saying, yeah, we'll buy your servicing, but you're going to have to pay me to buy the servicing from you. And, even an unsophisticated guy like myself can figure out that servicing is worth more than zero. So that's why we started to retain the vast majority of our servicing. And I would say that the servicing values are still, what buyers of servicing are trying to pay is still lower than what the actual value is, though it's much closer to market values today.
So it used to be bids over 1% at one point, correct?
Uh-huh.
So
yeah.
What they do is and to my investors out there, kind of bring back to the surface that particular conversation, was it used to be they take a bundle of loans and they would make a bid for a percentage of the value of that thing, something like a basis point, so 100 basis points or 1% or 1.2%, wherever that might be, to get the right to get those loans and collect those payments and take a little piece of each of those payments to make revenue. But when people are refinancing at such a rapid pace, it's just it's insanity the amount that we're seeing as far as refinance requests out there. And when that's happening, they're paying those loans off. Whoever bought that servicing does not have the time in that loan to be able to make back at least their investment, much less pay their overhead. And it's turning so quickly that they're being fastly obliterated because of buying it, but having to just run right out the door, right? So it's basically like going out and buying supplies it's kind of like having a bunch of teenagers, right? You're buying groceries, but they're disappearing before you even get a chance to eat the stuff.
That's a good analogy. Yeah. So buying that servicing right, you're basically buying a future cash stream, and your assumption is that cash stream is going to exist for 3 to 4 years. And so if it pays off in 1 year or in 6 months or 3 months, like we're seeing in some cases today, you're out all that revenue that upfront money that you put down for that future stream. So yeah, that refinancing can be a huge cost to guys with a lot of servicing.
Yeah, no kidding. It's more or less, to equate that for my real estate investors, you're buying an investment property that's supposed to be a revenue, right? It's supposed to have renters in there, but the renters are turning over so stinking fast, you never make any money.
Yep.
Right? Just continue to go in and out of it every month. You're barely even collecting anything on it. And then you got these gaps. So you're not making any capital. It's not worth holding. So you're going to actually charge a lot more, especially when you've got property managers charging to have owner to take it. You're going to start charging the property managers to have the right to even collect for you, right? So it's it tends to permeate all parts of the market when you start seeing how things are being interrupted by the normal practices not happening the way that they'd happened in the past.
Yep.
So
the nice thing about the servicing asset is it's kind of a natural hedge to the mortgage market. I mean, if you think about where rates are, when rates get lower, that's typically good for the mortgage market because a lot more people can afford homes to purchase, or they want to refinance their homes. So it helps the origination side. But when rates are lower, that actually decreases the value of servicing because, again, there are more finances out there. And so guys are paying out of their servicing. But then it also works in the opposite. When things slow down on the origination side, that's good for servicing values. And so at Security National, we really like the asset because we recognize that natural hedge and how it can help us in the downtimes.
And what is the performance of a portfolio? I guess, how does that affect the pricing? Because you're talking about people bidding on our assets, bidding on our mortgages, selling those mortgage-backed securities and those bundled up loans. How does the performance of the loans that we have in-house play into that?
Yeah, well, just as the speed at which the loans pay off is a big factor in valuing the servicing, but just as important is the delinquency percentage. So if you have $1 billion in servicing and 10% of that portfolio is not making their payments, that's a huge cost to the servicer. That not only is that revenue that they're not generating, in a lot of cases, that's revenue that they have to forward to the end investor, the mortgage-backed security holder, as the servicer. So it can be a huge drain to a lender's cash, beside being, missing out on the payment stream that should be coming into the servicer. And so the buyers of servicing are very dialed in about all those characteristics as it relates to a lender and the value of the servicing that they generate. So if our prepay speeds or our delinquency rates are higher than our peers, then we're going to pay for that in the value that guys are willing to pass through to us for our servicing.
So talking about those percentages you just talked about, say a 10% delinquency rate. So if we're talking about a servicer is going to make maybe 30 basis points a year on whatever they're servicing, correct? And they have to pay in this, and let's say in whatever coupon, they're going to pay that percentage interest, right? They're required to pay. And if Fannie Mae, let's say we did these investor loans and we had to go to the 3% coupon, they're paying somebody 3% on their money, period. Regardless of what happens, they got to pay that forward, regardless of whether or not whoever borrowed the money paid them. So correct. If the servicer has to collect and then make that payment of that 3% or 3 because of that coupon, and you've got 10% of their portfolio not paying, and they only get to keep 30 basis points, but yet they got to forward that 10%, the 3% interest, and they're not collecting any principal. You can see how they get underwater really, really, really fast.
Yeah.
Because they're not keeping much, and they got to pay overhead, right? They've got employees, they've got buildings, they got technology, got taxes. That's the biggest part of it. When you start stacking all that up, 10%, a lot of people might think, well, that's not real big. It's huge when you're thinking they're only keeping 30 basis points. That's $300 for every $100,000 deal they get to keep per year, right? 30 basis points per year. But they got to forward the payment on the loan that you're not making. If you're a person not making the loan payment, and if it's a percentage that's double digits, it's completely putting them underwater. They're not going to be able to survive that. So we've got to be, if we want, as real estate investors, and as consumers as well, people want to buy houses to live in. If you want to continue to have the capability to get that, you want to continue to have the capability to expand your rental portfolio, you got to be supportive of the people who are putting up the capital, one, for you to be able to get that. Two, supportive of the people who are putting it all together, like Dave and his department, companies like Security National Mortgage, bigger banks, everybody. I get where you're like, oh, they're making fortunes, but the risks are huge. Absolutely huge. So you need to always honor the commitment that you made of being able to make those payments and making a good decision about your business. Don't be crazy about just buying something because it sounds good, right? You better take the time to do the numbers, set your baselines, pick the properties that make sense, the ones that will stay rented. You've got to be able to make those payments, because if people don't do that, this particular thing goes away. 30-year fixed mortgages could go away. Your ability to build your portfolio in an extremely safe manner can go away. Any final thoughts to offer for us, Dave?
No, I think I appreciate what you're saying, and I think you're right on track as usual, as has been expected from you after all these years.
Well, thank you. I hope to always live up to expectation. It took me a long time to set the expectation with Security National. It took years took years of us working together to see how, whether or not what I said and how I acted was bullshit. Was it something that, is it going to work itself out in the numbers? And now we're able to show with 5 years of history that's working itself out in the numbers. And I am absolutely adamant. We've got to do good business, not just us as Security National, but our clients have to do good business. They have to do it for the right reason.
There's a lot of guys in your position that are looking to take shortcuts to, make a quick buck. And it's great to hear what you say and to see your commitment to your industry, and see you act as a real professional. It's a tribute to your character and the business you've built.
Well, thank you. I'm in it for the long haul. Like I tell people, I'm not retiring. When I go to the grave, I'm coming in hot, and I need to be able to have my freedom, right? And my ability to keep doing what I do. I can't have that taken away from me. But there's too many damn people that count on me doing the right kind of thing. My employees, the people within Security National, those who put up the capital within, buying our stock, and all those shareholders, the board, and our clients and our referral sources. We need to be that light out there. People says, you want to know how to do business right? You look to that sign, that S and that N, and that crazy redneck bastard with the beard with the steel chainsaw hat. You look over there, you'll know how to be successful. So thanks, man, for what you do, for coming back on. We're going to get him on one more time, guys, when he's able to be in the office, so we can do some screen share of all the crazy alchemy he's got to look at on his screen. Because I think it's going to be really interesting to all of us. If anything, you're going to be extremely impressed and confused. So thanks, buddy.
Well, great to be with you. Thanks, Aaron.